There are many things investors cannot control. We have no control over markets. We can't control decisions by corporate managers. We have no say when it comes to Federal Reserve policy decisions. There is, however, one critical part of investing that we can control, and that is reducing the investment fees we pay to a minimum. When talking about stock market investing, the talk used to be a lot more about individual stocks, but today you are hearing more and more talk about funds, and there are all kinds of funds. Active mutual funds, passive funds, exchange-traded funds, hedge funds, private funds. In fact, we have more funds than securities today. In case you have no idea what a fund is, they are entities that pooled money from different people to invest, and they are managed by investment management companies, for example, Fidelity, BlackRock, and Bridgewater Associates, and so on and so forth. As with all services provided in this world, nothing comes for free. So you pay fees to these companies to manage your money. But to be fair, it does cost a fair bit to run a fund, because aside from the fund management company that gets the management fee, there are many others trying to take a bite out of the pie. For example, your sales guys, landlord, governors, brokers, research companies, and so on. So to get a clear picture on the cumulative impact fees can have on an investment portfolio, you need to take a long-term perspective. Consider a model portfolio consisting of 80% stocks and 20% bonds. According to index fund advisors, a fee-only advisory and wealth management firm, our management portfolio would have returned over just 10% per year since 1928. Taking this return as given and assuming a fixed investment of $100 a month over a 45-year career, our portfolio would grow to approximately $1,050,000 before accounting for fees. Now let's assume our model portfolio incurs annual fees equal to 1% of the portfolio's value. While the market may have returned 10% a year, our hypothetical investor would have received a 9% annual return after fees, resulting in the portfolio valued at only $740,000 after 45 years. A seemingly small fee of just 1% a year consumed 30% of the model portfolio's potential value. So what kind of fees could you be paying? There are two major types of fees that investors who own mutual funds or use financial advisors should be aware of. The first is known as an expense ratio, which is the cost of owning certain mutual funds or exchange-traded funds expressed as a percentage of the fund's assets. For example, an expense ratio of 1% means that if you have $10,000 invested in a certain mutual fund, you're paying $100 in annual investment fees. This covers expenses such as the fund manager's salaries, as well as any administrative fees and costs of operating the fund. Mutual fund expenses can also include sales charges. It's also important to mention that all mutual fund products have some type of expense ratio, even those held in your 401k or similar retirement plans. It's a common misconception that 401k investments don't cost anything. They do. The second major type of fee is known as an advisory fee, which is generally also a percentage of assets under management. Like expense ratios, advisory fees can vary considerably, but 1 to 2% of assets is typical. This is on top of any fee charged by the fund your advisor chooses to invest in. For example, Personal Capital's report found that a certain well-known investment advisory firm charges clients an advisory fee of 1 to 2%, and the average fee charged by the funds in its client's account is 0.33%. This translates to a total fee of 1.33% to 2.33%. Investment fees aren't the whole story, however, and some might argue that what really matters is the after-fee return of an investment. High fees charged by an active managed mutual fund might be justified if its returns on an after-fee basis beat a comparable index fund investment. History tells us, however, that the performance of actively managed funds often lags their less expensive competitors. S&P Global publishes data comparing the performance of US equity managers as compared to relevant benchmarks, called the SPIVA US scorecard. The results do not bode well for the actively managed mutual funds. According to SPIVA scorecard report, 70% of domestic equity funds lagged the S&P Composite 1500 index, a very broad measuring of the stock market performance, in 2019. Looking back over the past decade doesn't improve these results. 71% of funds underperformed the S&P 500 for each of the last 10 years, to be fair. Results can improve for other asset classes year to year. Mid and small cap managers, for example, tend to do better. 68% of mid-cap funds beat the S&P Mid-Cap 400 in 2019. And in the 10 years to 2019, however, 84% of mid-cap and 89% of small-cap funds underperformed their benchmarks, according to the SPIVA report. In short, higher fees don't translate into better after-fee returns. But some fees are okay, but be aware of the differences they can make. I'm not saying fees are inherently bad. In fact, many financial advisors provide other services at no additional cost, such as insurance and estate planning and advice. If you feel like an advisor is truly earning their fee, it can be certainly money well spent. My point rather is that excessive fees should be avoided. An example of an excessive fee would be paying a financial advisor 1.5% when you could get the same service for 1%, or investing in a mutual fund with a 0.8% expense ratio when there are similar products that accomplish the same objective for a fraction of the cost. Here's why it's so important. Let's say you invest $10,000 per year and that your investments earn an average total return of 7% per year. Before expenses, if you pay total fees of 1%, you can expect to have a nest egg of $1,114,000 after 30 years. On the other hand, if you pay a total fee of 2%, your investment would build up to $903,000, a full $211,000 less. Paying higher fees can literally cost you hundreds of thousands of dollars. In his 2016 letter to Berkshire Hathaway shareholders, Warren Buffett wrote, "When trillions of dollars are managed by Wall Streeters charging high fees, it's usually the managers who reap outsized profits, not the clients." In other words, while many Americans think that the high fee investment produces better returns, the opposite is often true. High fees generally have the effect of making someone else rich, not you. Conversely, the lower your investment fees, the more your profits that will stay in your investment account, which can produce a pretty amazing compounding effect over time. Whether you're choosing to invest in your 401k investments, looking for a financial advisor, or thinking about investing in mutual funds or ETFs on your own, the fee should be a major part in your decision-making process. Hopefully this video helped understanding a bit more about the different types of investment fees and how important it is to understand them and to ensure you are not missing out on a large potential gains and putting your hard-worked money and invested cash into the pockets of these massive companies and wealth managers. For more weekly business and finance content, subscribe and leave your thoughts on fees and investing in general in the comments.